Welcome to Learning Outcome 2, where we look at the common elements of the conceptual frameworks for financial reporting. Now, in the previous learning objective, I showed you a slide from your Deegan textbook. Now, here's another one that you might find useful, and it provides an all-encompassing guide to the various elements and how you might characterise them. Most of these we're going to visit during this little presentation, but not all of them. The first thing we need to know about the conceptual framework and its elements is what is a reporting entity and why does it even matter? So the idea of the reporting entity drives the application of the conceptual framework and its resulting standards. So the conceptual framework is focused only on the production of general purpose financial reports. Therefore, the definition of a reporting entity limits the application of the conceptual framework and the resulting standards. A reporting entity is therefore one that must produce general purpose financial reports. If you're not required to produce them, then the conceptual framework is not that interested in you. And who are the users of general purpose financial reports? Well, they are external to the entity. That doesn't mean that people inside the firm can't use general purpose financial reports. Your chief financial officer, your CEO, the board of directors should and will certainly look at those reports, but they're not published for them. They are published for people outside. Why is that? Because the people inside the firm can command better reports. They can see things in more detail and they can command reports whenever they need them. Not so for people outside, such as your shareholders. So general purpose financial reports are really designed and published with those people in mind. Who are the primary users of general purpose financial reports? Well, they're your actual and potential investors, lenders, and other creditors. Other users can involve regulators, such as the government or the tax office, other members of the public, such as you as students, for example, and generally anybody else who might find those reports useful. Now, because that's a wide range of people, and because it's not possible to take into account the needs of a range of people who could be anyone, we don't know who they are, we assume something about them. So we assume that the users of general purpose financial reports have a reasonable knowledge, a reasonable accounting knowledge. We don't assume that they are accountants or have accountancy degrees, but we assume that they're capable of reading those financial statements, financial reports with some proficiency. So we make those assumptions because we can allow more technical detail within those financial reports. If we'd assume, for example, that the users of financial reports only have a grade 10 education, then the conceptual framework would mandate a much more simplified presentation. So the objective of general purpose financial reports, which we read this in the previous learning objective, it's changed over time. So historically the focus was on stewardship. So the objective of financial reporting was to allow users, investors, to judge the effectiveness and the integrity of management of the firm. And those kinds of reports focused on past actions and predicting future cash flows. So in other words, the investor could decide whether or not the management of that firm is doing a good enough job. Now the focus has shifted on to the users as decision makers. And this is what we call a decision usefulness approach. Now, an important central element of the conceptual framework involves the qualitative characteristics of financial reports. So qualitative meaning not quantitative. This is where we look at what sort of characteristics and qualities do we want our financial reports to exhibit. So over here on the left-hand side, we're kicking off with relevance. So the financial report must include information that is materially relevant. And we know something is material if the information is absent, then the decision maker may make a different decision. That's how we come to know which information is material or not. We want to make sure that the information provides a faithful representation of the entity. And we do this by ensuring and requiring that financial reports are complete. In other words, that they contain all of the information needed within that reporting period and only the information from that reporting period. We expect that the reports are neutral, so they're free from bias. So we hope that the reports are reporting what's actually happened, both good and bad. And they're not simply a reflection of some senior manager or accountant wanting to adversely influence an investor's decision. And of course, we want them to be free from error. Now, this does not mean that we expect our financial statements to be absolutely accurate. We know that perfection is not a good trait in humans. So, free from error as far as possible, but we don't expect perfection. Now, between those two broad objectives, those qualitative characteristics, we also demand some characteristics that enhance or help meet those characteristics. So comparability, for example. We want our financial reports to be comparable with similar firms in the same industry or within the same firm over the period of time. They need to be verifiable. Someone needs to be able to come and check those reports. They need to be timely so that the financial reports get to the investors in enough time for the investor to make reasonable decisions. Now, you should make note that timeliness and free from error are two competing forces here. You can understand, for example, if you published a financial report the day after the financial period closed, that's extremely timely, but the accuracy is unable to be gauged because it takes a lot of preparation and it takes involvement from external audit to make sure the financial report is ready for the investors. So getting that balance between being timely and free from error is a very important consideration. And finally, understandability. Of course, we want our reports to be understandable. They need to comply with the accounting standards. And so we want our reports to be able to be read and understand with people with enough basic knowledge of accounting to be able to do that. Now, getting to the more basic elements of the financial report, we have some principles here. Number one is the recognition principle. And so this is about when do things actually get put into a financial statement. We recognise them, in other words, to put them in the financial statement when it's probable that any future economic benefit will either flow to or from the entity, and that the item has a cost or value that can be measured. So this recognition principle really limits the kind of things that can go into your financial reports. And the measurement principle, this has been the most problematic area for accounting. Now, we met and read through a lot of the issues in measurement from the previous module. So in the conceptual framework, it allows for a range of different measures. And so assets and liabilities are allowed to be measured in a variety of ways. And so this, as you change these different ways of measuring, this directly impacts upon income. It can either boost or detract from income. So this is a very important area for accounting decision-making. Now, those two principles we apply to the various elements of financial reporting. And there are 5 elements. They are assets, liabilities, equity, income, and expenses. So assets are resources controlled by the entity as a result of past events from which future economic benefits are expected to flow to the entity. Now, in years past, there's more emphasis on assets being owned by the entity, but now we talk about assets being controlled. Now, this has a major impact on how we record and report on leases, for example. So note that they need to be controlled but not owned. And assets must be a result of a transaction that's already occurred. So we can't book something as an asset because it might happen in the future. We can't do that. Similarly with liabilities, a liability is a present obligation arising from past events which are expected to result in an outflow of economic benefits from the entity. So economic benefits will flow from the entity, from the firm to somebody else in the future. But it's a present obligation resulting from a past transaction. Equity is regarded by the conceptual framework as simply equaling your net assets. So in other words, the residual value of all your assets, once the value of your liabilities are deducted, that amount your equity must equal. Income represents the net increases in benefits to the firm due to increase in assets or decrease in liabilities or both. And we don't include in this any contributions to equity made by the owners of the firm. Expenses are the flip side, and they represent the decrease in economic benefits to the firm from either depletions of your assets or increases in your liabilities. And we exclude from this any distributions of money to the equity holders. So that's a quick tour of the important elements of the conceptual framework. In our next presentation, we'll look at the real benefits of having a conceptual framework, and we'll also consider some of the criticisms that have been levelled at the conceptual framework. So I'll see you then. Bye.